So we will now continue with a keynote speech by Adam Posen, president of the Peterson Institute for International Economics, on the topic of EU in a changing geopolitical landscape. Dr. Posen has extensively contributed to research and public policy on a wide variety of G20 macroeconomic issues, including European integration since the euro, inflation targeting, and the future of globalization. During Dr. Posen's presidency, the Peterson Institute has won global recognition as the leading independent think tank in international economics. The response to his speech will be given by Thorsten Beck, director of the Florence School of Banking and Finance and chair of the ESRB Advisory Scientific Committee. May I ask the gentleman to the stage, please?
Good morning. Please let me offer my thanks to President Lagarde, Governor Rain, to the ESRB, and the conference organizers. I have been coming to Frankfurt on various issues from the time I was an intern at the Bundesbank in fall of 1992. And it has been a pleasure to work with many in this room, and many of you are too young, as the euro has gone from concept to reality, from reality to success, and now by need and capability from success to global leadership. This is an interesting time to be trying to explain Washington to people in the world, and what I'm going to try to do today is both take you through my sense of what I called in a recent article the new economic geography, but then try to link it directly to the concerns of Europe and to the ESRB. I will leave it to the more expert systemic risk people in the room to map it into the categories that President Lagarde so succinctly put out. But I think this is in the same spirit of trying to identify risks, trying to reduce range of uncertainty, and trying to prioritize responses in an underlying way. So with that, if this works, yes. I think we have to start, I guess, even though it's Frankfurt, by quoting President Macron. The peace dividend is gone. And of course, he was speaking about this in the context of Ukraine and whether or not NATO and the US are sufficient in Ukraine. But I would emphasize, as I've been warning for a couple of years now, that the peace dividend should be conceived of as more than just defense spending. It was an environment in which Europe and many countries and businesses and investors around the world could take peace for granted. And that clearly is not the same. And so how do we think about that situation? So let me, instead of a submarine, let me talk about a beach house. The regime shift we're undergoing, and by regime I mean both the nature of the US government, but the economic regime that we're all under, is imagine you had a beach house and you had very good insurance on the beach house. So even no matter what happened, you were willing to put money in the beach house, and because you were there and had insurance, others put money in, and suddenly you have Malibu. But now the waters are rising, global warming is in place, the world is more volatile. Ideally, you could then just pay a bit more for a bit more coverage. You could reprice the risk. But what has happened is instead the insurer has decided to become extractive. And the insurer is basically saying, you have to pay me under the table, and I'm going to play hardball when you make a claim, and I'm probably going to triple your premium, and if you don't pay the triple premium, I'm going to withdraw coverage. And this is reality for people in Florida and Texas and California, but arguably this is the reality for the world today. Your risks are going up, your real income is going down, and you're losing this insurance. So the question is, how do you a self-insurer after years of having had an insurer. And things will be worse than they used to be, at least for a while. But there are much better and worse forms of self-insurance. And I think Europe is actually well positioned to make a material difference in how well its own self-insurance and its effects on the rest of the world function. So just to make the analogy clear, I published a couple weeks ago this article, and the US has basically, in financial terms, reduced the insurance provided and especially reduced the safety of dollar assets. It's not that there's fewer dollar assets. In fact, we may end up with more dollar assets, but they are less liquid and less safe than they once were. And indeed, this is what I'll call the irony of the alliances. Those economies that were most dependent on the US insurance and counted on it the most are the ones that are being most affected and most harmed, whether that's the UK and Japan, Canada and Mexico, and to a slightly lesser but very real degree, Europe. And unfortunately, this is not a steady state, or rather it is a steady state of turmoil, that these terms will constantly be renegotiated. And a key point that Charles Kindleberger, who Christine Lagarde invoked, would recognize is that the security and the economic dynamics reinforce each other. What happens at the Munich Security Conference also affects what happens at Jackson Hole and Sintra. And so again, the issue is not that we have fewer safe assets, which I know is a theme that the ECB and the ESRB have thought about a lot, but that what was the safe asset is no longer as safe. And so to be a little more concrete, I want you to all recognize that the change in the US policy as an insurer to extractor is quite fundamental and likely to be lasting. This is like Brexit. It's not that the uncertainty comes and gets resolved. The uncertainty remains. And this is going to have major impacts on the US economy and on the global economy. And we should be very aware of changes in capital flows, in changes of fiscal financing. And there is a tendency to be either fatalistic or deterministic, depending on what tone you want, about this, that this assures China's rise or this assures something bad. There is a lot to play for. And I say that not just to be hopeful and not just to have something to do. It is genuinely part of international relations. If we're in a world of more turmoil and less guarantees, diplomacy matters more, individual transactions matter more, alliances matter more. So I'm not going to belabor this, but for some of you in the room who heard me give briefings since the election as far back as November, where we are is actually where it was clear we were going to be. Across the board tariffs, few specific sectors, demands for linked arms sales, FDI, energy purchases, particular harshness on neighbors. This is where Trump was going to go. This is where he has gone. This is a steady state. It may feel unstable, but it is a steady state. And so as I said, with regard to Brexit, what you had is there is no resolution. And I remember fighting with people, both who were for and against Brexit, who kept saying, well, is it a hard Brexit? Is it a soft Brexit? Is it Boris Johnson or is it Theresa May? What's the relationship with Europe? And I kept saying, the problem with Brexit isn't uncertainty about Brexit. The problem with Brexit is Brexit. And the same is true with Trump. And people in the US, probably more than in Europe, keep kidding themselves that at some point the uncertainty resolves. That is not the point. And if you replicated the chart on the left with Nick Bloom's data on the most recent data, that's what you see, a spike in uncertainty at April 1st, April Fool's Liberation Day, and then remaining high uncertainty since, and we should expect that to continue. And so we have seen over Trump 1, Biden, and Trump 2, a significant reduction in Chinese imports. We have seen China shifting to new markets, to Europe, to the developing world. This is all based on work by my colleagues Mary Lovely, Chad Bown, and others at the Peterson Institute. But importantly, which you may realize but not fully, is the EU has significantly increased its reliance on Chinese technology. And this is likely to continue. It's very expensive to disentangle, and that has to be kept in mind as we go forward. But turning to monetary issues, there's a very big interaction between foreign policy and the role of the US dollar. The US dollar dominated in part because of lack of viable alternative. I mean no disrespect. I see Marco Butti in the audience. He and I worked together on a series of volumes, the euro at 5, the euro at 10, ready for a global role with Jean Pisani-Ferry and others. And the euro was not ready. But part of this was the security regime. And when I published a paper back in whenever it was, 2008, about why the euro will not rival the dollar, I emphasized this, that it was security relationships, alliance relationships that partly underpinned the centrality of the dollar. And then later on, Barry Eichengreen, Mehel, and Chihu did a far more sophisticated econometric analysis and bore this out, that there's on their row, 30% of the dollar's overvaluation is, or not overvaluation, excuse me, overweight in various portfolios, depending how you decide, is due to security relationships. And so one has to assume that as Europe moves forward on security, you're reversing what I said in 2008. Maybe not fast enough, maybe not completely vis-a-vis the dollar, but this is a fundamental tailwind to the global acceptance of the dollar. And my colleague Jacob from Kierkegaard has been tracking European defense spending, as has others in Europe. And this is a proxy for that. But what it also means is, from a macro perspective, additional defense spending may be strengthening of the role of the euro and its global usage, rather than the usual knee-jerk defense spending is weakening because it leads to fiscal problems. So now let me talk about, if that's the broad landscape, and I'm happy to discuss more details of it, but those would be some of the features and give you an intuition. Let me talk about some of the systemic risks that arise out of this. So the first one, which the commissioner mentioned in her video address, is recurrent trade conflicts causing supply and investment shocks. These are real. These are not systemic in the more narrow financial sense. So I'm going to focus on the others. One which I think comes from the real economy side, but which people underestimate, is how much we're going to have diverging standards now. The US, in addition to being overrepresented in portfolios, US business, US influence, was overrepresented in the setting of standards. And we've all been through the back and forth about Solvency II and Basel III and all of this. It was never passively accepting the US or the US never agreeing. But one should expect a more fragmented world where these differences are going to persist. And this is also going to come, of course, in response to climate change. If the US is on a path of hybrid cars and fossil fuel for an extended period, while Europe is leading the way on green technology. There will be other factors that I will go through. So in part, we can talk about a number of real side issues that perhaps the ESRB doesn't usually focus on. But one in particular I wanted to emphasize, and obviously I had no knowledge ahead of time of Christine's speech, but is the divergence over stablecoins and digital currencies. And the point I want to emphasize is we have trade deals, as we have financial deals, to manage places of divergence. You don't have trade deals actually because the trade's going to occur. The point of the trade deal is to manage where there's friction. And this is where things will erode. We have this very strange duality, well, not so strange, very understandable duality of the Genius Act, the US saying the Fed cannot have a central bank digital currency, but we're pushing very hard private-owned stablecoins. Europe says we're going to have the world's leading central bank digital currency, and we're being careful about stablecoins. And this, I think, just to echo what's being said, I think is one of the most critical things you have to look at going forward, and I'll come back to this. I think what's also important is the risk of a potentially persisting diverging R-star or fundamental long-term interest rate between the US and China, but potentially the EU as well. That in the end, you can try to route things through Dubai or Singapore or wherever, but the fact remains that national identities are going to increasingly determine who gets what investment opportunities, who has what liquidity and safety in a given investment. And we're going in a world where financial flows fragment, where imagine essentially the savings glut stops flowing from China to the US. You get deflationary pressures in China with the savings bottled up and higher interest rates in the US, which is trying to finance with a lower pool of savings to draw on. Reduced migration, sadly, is going to have similar effects on labor markets. And so divergences between wage rates, which isn't entirely bad, but has to be taken into account, is going to return. And importantly, on the real side, tech diffusion. If you have different standards, different national champions, not winner takes all from individual countries, those will diverge as well. And Luis Garicano at LSE just wrote a short piece I thought was very insightful in this spirit, building on the Jackson Hole paper by Staub et al., that if you have technological leap forward in some fashion in AI in the US and Europe is not keeping pace, you may be facing financially the same interest rate and a lower productivity growth rate, and this puts a wedge. So you have to think in terms of these persistent wedges across geopolitics in our start. Third, I've already mentioned the dollar. The term I tend to use is decentering the dollar. Dollar's not going away as a reserve currency. It's not going to nothing, but it is becoming less central through the actions of the Trump administration and the associated reactions of world markets. My colleague Maury Obstfeld at LN Ray have done sophisticated studies of this, so have many others. Essentially, it's not that the dollar's gone into free fall, but it's now 5 or 6 times that the correlation between long-term interest rates and dollar strength has gone the wrong way when under pressure. This is a very revealing dynamic. And here again, the interaction between security and economic relationships underpins this dynamic. We had the privilege to host Philip Lane and Klaus Knott recently at the Peterson Institute last spring, and there were speeches by President Lagarde and others talking about the sovereignty, safety needs to have your own payment system. We're also talking about different weapon systems. We're talking about the US government threatening capital inflow, outflow taxes and distinguishing between investors, domestic and foreign. We are talking about greater allocation to alternative assets. I mentioned this in brief remarks at the BIS annual meeting, that the erosion of trust and information, and unfortunately the erosion in data collection, which the US is now contributing to, will continue to increase private sector demand for so-called alternative assets, be these stable coins or crypto, be these gold, be these timber, be these what have you. And just as in public health, one has to take into account ongoing awareness of refusal to take vaccines and to register. We have to accept and take as a reality in this environment, it's contagious, a reality in this, it's sympathy, I'm showing solidarity. Reality in this environment that there is going to be an increase in the share of assets being allocated and flows into and out of these asset sets, as opposed to the non-bank financial intermediaries. This is a different class. I think a point I want to flag that is never raised in polite company and never publicly raised is it is right for other governments, other financial regulators to be worried about the politicization of the Fed swap lines. Reportedly, Chair Powell and under pressure, Secretary Bessent at the spring G20 meeting assured everyone there is no problem. I'm sure Jay Powell wants there to be no problem, It is certainly in the interest of the US as well as everyone else that there be no problem. It is certainly, if I was sitting in this building or anything close to it, not something I would take for granted. My insurer may try to ask for additional payments or may try to reject a claim at a critical moment. So I think whether it's acknowledged publicly or not, there has to be thinking short-term about alternative pooling of assets and swap lines in dollars among major central banks and governments, and there has to be thinking about getting certain systemic institutions out of dollar liquidity needs over the medium to long term. A quick note that is a little bit outside your remit, something I identified a few years ago, which sadly has been borne out, is that in this political economy, as well as for other fundamental economic reasons, the performance of the largest EM, India, Indonesia, Brazil, to some degree Mexico, Turkey, is more and more diverging and separating or tiering itself away from the rest of low and middle income economies. And you can see this in what happened with the volatility or lack of financial breakage in these economies when the Fed had its tightening cycle just recently. It was historically unprecedented. You would see the Fed move 550 basis points in no time flat, and there were no financial crises in these major economies. At the same time, as the IMF and the World Bank have rightly pointed to, the net indebtedness position of a huge number of developing economies has gone way up. And so in the political economy we're facing, this divergence is likely to continue. The largest economies, largest EM, will be in a position to be represented at the G20 to attract disproportionate amounts of capital inflows, to be an alternative as part of a broad portfolio, whereas we will expect capital to still be rolling uphill, perhaps even more drastically, from the rest of the developing world. And again, some of this is due to good policymaking and reforms in these major economies, and they represent a few billion people. So I don't want to suggest this is an entirely bad thing. But I think it is important to see that if the G20, the FSB, the IMFC, whatever group you want, was unable to bridge US-China divisions and other divisions to create debt relief in a meaningful way or change the nature of these flows in previous years, that dynamic will be even more reinforced in coming years. And from a systemic risk point of view, to go with your central bank digital currency, and in the spirit of something Christine said about differential bailout possibilities or liquidity possibilities, Europe has to be ready for large capital inflows from the developing world in a way you have not seen previously. Finally, again, I did not coordinate on this, and so perhaps I am already speaking the obvious, but this has not been said very much in public. The US is going to engage in increasing alternative assets with reduced supervision. So there is an understanding of other countries, but also other investors, deciding that they're worried about not getting access to resources, they're worried about expropriation, they're worried about sanctions or IP monitoring. And as Brunnemeyer, James, and Landau pointed out several years ago, this is a scenario for capital flight from weaker currencies. And this is potentially a race to the bottom. What I'm going to say publicly that, again, probably the people in this room know, but are too polite to say, is this is part of what's at stake with Fed independence. The Board of Governors, in our crazy system in the US, the Board of Governors has control over a number of financial supervisory and regulatory decisions without the need for votes from the full FOMC. So leaving aside the broader central bank independence issue, leaving aside any specific people, leaving aside the question of whether the Reserve Bank presidents will be dislodged, if Trump's regime gets a majority control on the Board of Governors, they can make a number of very important decisions with respect to financial stability, including notably for crypto, very quickly. And I will note a fact. There was a recent report in the New Yorker, a great article of forensic journalism to try to say how much money has the Trump family accumulated since President Trump retook office. The number they come up with is roughly 4.2 billion, of which 3.2 something is in crypto. So one has to be not just aware that there is a huge conflict of interest here, but aware that this is, to my mind, part of the consequences, if not the motivation, for the aggressive acts towards the Fed, and why getting a majority on the Board of Governors may mean the time is very short to prepare for this. So now let me turn to conclusion about Europe, and more Euro and more Europe. Don't despair. Europe can make things better. I've been harping on this for the last few months. I was proud to give the Patasciapa address at the Brussels Economic Forum a couple months ago, and I recently published something in the Frankfurter Allgemein about this. I'm not trying to show off, I'm just trying to follow the academics who always cite their own work. My main message is Europe's way forward in this environment, in this new economic geography, is to be itself. There is a false sense, falling into a Trumpian mode of thinking, that if China misbehaves, if the US misbehaves, we have to play their game. We have to be in an arms race up with them on industrial policy. We may not want to race all the way to the bottom on regulation, but we have to think about it. We need to do subsidies. We need national champions, and so on and so forth. This is wrong. This is wrong fundamentally analytically, and it is wrong because Europe cannot compete with China or the US on that basis. If Europe plays its own game, and particularly the European Central Bank and the European system, Euro system play their own game in financial regulation and monetary stability, the good will come to you. It will be all a question of how actively and positively you manage the fact that from henceforth, for the next several years at a minimum, you will be the rising currency, not China, not US. You will be the safer asset, relatively speaking. You will be the place of rule of law. And so there are a lot of places you can make this argument in terms of pursuing talent from around the world, in terms of pursuing innovation, in terms of green standards. But particularly, I want to emphasize on the financial monetary side, and this is where I'll conclude. The ECB, the ESRB, the system can provide partial insurance, not just to itself, but in its enlightened self-interest to others. You will, by default, be much more independent than the Fed. You will have to accept, and ideally should lean into, if I can still use that phrase, the euro gaining strength. You will need to more proactively cooperate with governments having capital outflows into European Central Bank digital currency. You will have to team with other central banks, and it's going to have to start being open. The benefits versus the costs of being open about it will be high. About having alternative swap lines. And to be partisan, I'm afraid, in a small way, you have to encourage greater euro area debt issuance to be joint, as my colleagues Angelo Bide and Olivier Blanchard have been arguing, and as I know people have discussed. But in particular, you're also going to have to stand up to your governments and avoid tit for tat, not be national discriminatory about the identity of investors. And in particular, and I was very glad to hear the president's remarks, and I'm sure it's true, you need to hold the line on crypto and stablecoins because this is where the US is frankly likely to make a very grievous error. And you will gain, even if in the short term they sell a lot of treasuries, you will gain by being the point of relative stability. And finally, in the technical weeds part, I would encourage the ESRB, as part of its research, as part of its monitoring, to be very forthright about flagging risks arising from the US. Somebody's got to do it. and the IMF and others may not be fully able to do so. So with that, thank you for your time. Thank you very much for having me.
Well, thank you very much. Good morning. And well, first of all, thank you for inviting me. Thank you for Thomas helping me out in times of need. Now, and thank you, Adam, for this very inspiring and also very honest assessment. Now, in the program, my intervention is not noted as a discussion, but rather as a response, and that's what I would like to do, because I don't have much to argue with what Adam has said. So I'd like to kind of focus on what I think, and what he has kind of already started in the last slide, about what should be the European response to these changes in geopolitical and the geoeconomic landscape. Now, we are living in unprecedented and very volatile times, where long-standing truths either no longer hold or at least have to be questioned, and where out-of-the-box thinking is certainly required. But, and as already alluded to by Adam, the European response to these new circumstances does bring to the fore certain tensions that have been around before but are being emphasized even more now. And I'm going to discuss 4 of these tensions in the following. And on doing so, I will also touch upon some of the themes that Adam has mentioned. So the first tension is between the idea of just an economic union and the need to create a geopolitical power center. And very interestingly, Adam, you referred to Brexit, and I cannot avoid of referring to Brexit either, because in 2016 I lived in London and I was following the Brexit campaign, obviously. And very interestingly, the Brexiters wrongly claimed that the UK had been duped in 1973 by joining what they thought was an economic union, and then supposedly was becoming a political union. And they were even talking about a European army back then. Of course, that 2016, that wasn't really an issue. But now we are actually kind of at this stage. Interestingly, in hindsight, you could actually almost argue maybe the Brexiters was right. Or maybe the same forces that led to Brexit are actually also behind this need to focus more on the EU as a geopolitical power than just an economic union. Because for many years, of course, we have focused on ever closer union, but really on macroeconomic terms, on economic terms, while any effort towards a political union has been kind of shot down very, very quickly. Now, as the insurance by the US is kind of falling away, and the Article 5 guarantee of the NATO treaty is kind of being put into doubt, I think there is nothing but a stronger need for a stronger geopolitical role for the EU. Now, a second tension I would like to discuss is that between open markets and strategic autonomy. So Europe has always been at the forefront of open markets, kind of driving also the global trade integration process. And we certainly do not want to become isolationists, as you mentioned yourself. We want to kind of be ourselves in terms of being an open society. But at the same time, we have to create the structures to function on our own if are left to our own, and if this insurance, and not just the insurance, but other things, as you mentioned, actually go away. And of course, that relates back to the Savings and Investment Union mentioned by the Commissioner. So we can finally benefit from these enormous scale economies that we do have in the European Union. We have this enormous scale, but we still have national financial markets, national banking system, and I think we really have to overcome this. It also requires relying less on the US dollar as a global reserve currency, as you also said, and of course also on other things like the financial infrastructure. And it's not just about the swap lines, it is about the payment systems, for example, Visa, MasterCard, and I think there the digital euro can certainly make some process. And in this context, of course, the need for kind of strengthening the financial markets in Europe and kind of gaining geopolitical power, kind of becoming more prominent, and having also the euro as maybe as a more prominent reserve currency is certainly aligned. And of course, not to mention here, I also agree with you that, of course, if you want to have also the euro have a stronger role for the euro, including as a reserve currency, yes, we do need more safe assets in the euro area. That's certainly true. Third tension between markets and governments. Now, we economists know, well, we think we know, that markets often know best. And I think the historic experience has shown that planned economies have not really been successful in human history. We also know there are lots of markets failures. And there's an important role for governments to play beyond setting the rules of the game, beyond the rule of law. But of course, there has been always this debate among economists to market failure versus government failure. How can we have, for example, industrial policy, which might be needed, while at the same time avoiding that this gets entrenched? There are just subsidies chains, and that the government failure takes over the market failure. And I think, again, the EU has an important role there to play because it's more arm's length. It's maybe a little bit more removed from the national interest, from the national political interest, so I think it can be also helpful. Now, in this context of markets versus governments, there is also this tension, I would say, between stability on the one hand, innovation growth on the other hand. And again, we can see it in the context of crypto and stable coins. Now, Europe has often been accused of heavy-handedness when it comes to regulation of crypto, of stable coins, of AI. Whenever something moves, we Europeans have this tendency, go and let's regulate it. While it seems that in the US it goes the other way, where actually the government is being prevented from taking any role in the digitalization of finance by prohibiting, for example, the Federal Reserve from going ahead with central bank digital currencies. And it's all money, all coins are being set, coins, literally, digital coins being set on the private sector. Now, I'm not quite sure this is just market versus government. Maybe it's also public versus private interests. I mean, sometimes we think that government is not always public interest, maybe it's sometimes also private interest. But I think in this case, I think the public interest is strong on our side, whereas, as you set out yourself in one of your last slides, this focus in the US on anything crypto goes is not really about public, it's really about private interests. It's about letting 1,000 crypto assets bloom, rip off a couple of millions and make a couple of dozens very, very rich. Certainly not in the long run public interest. The last point, the last kind of tension I want to mention, and I think that's maybe a critical one, especially in the context of Europe, this what I call populism versus technocracy. Now, this is a room full of technocrats. And we all know the wording, the people versus the elite, enemies of the people, will of the people. Citizens of nowhere. I mean, again, being in London in 2016, I've got to see them all. And of course, we know, and those who have studied European history of the 20th century, that sounds very familiar. I mean, it's authoritarianism dressed up as populism. Now, history doesn't repeat itself, but it certainly does rhyme. And we do have the populist Ante Porta. And it's, of course, the undermining, the fighting against the institutions, judiciary, independent statistical offices. It's, of course, it's a widespread one. We've seen it in the US kind of moving forwards very prominently, but of course we've also seen similar attempts in Europe once in a while. I mean, I just think about Greece and the statistical office, for example. Now, of course, very concretely coming back to the building where we're sitting, political independence of central bank is being undermined, which of course also affects financial regulators and supervisors. And of course, this is, I would say, and Gita Gopinath, the outgoing first deputy managing director of the IMF, kind of put this very nicely in her, what I guess I would call it, exit interview with the Financial Times. I think this is one of the insights from economics that has really been proven correctly. Independent central banks can be incredibly helpful for price stability, but also for financial stability. Who should make the case for independent technocrats? I mean, some people say, well, the technocrats themselves have no role in defending their own independence. I actually disagree with that. So I think, yes, we academics have a role to play in kind of making the case that this is important, but I think also technocrats themselves central bankers themselves have to stand up and make the case that independence is something very positive, that the societies have benefited from it. At the same time, of course, there has to be accountability. I'm not going to talk about mortgage applications and clerical errors, but yes, there is accountability, there is transparency, and there's a need for increasing dialogue, I think, between technocrats and the people. Now, at the same time, I think, and again, this is a difference between the US and Europe, and again, we need strong and robust democratic defenses. And of course, as you have heard by now, being German and having studied myself German history of the 20th centuries and the demise of the Weimar Republic, it's obvious, it's clear that the enemies of the democracy cannot have the same rights as actors supporting and playing within the general rules of the game. And I think that's when it also comes to this whole idea about free speech and guaranteeing the games of the rules of the games and the institutions. I think that is a very important thing to keep in mind. In some unprecedented times, demand robust but also ambitious responses, strengthening our economic resilience, asserting a global role for Europe, which goes beyond the economic union, also goes towards playing a geopolitical and geoeconomic role, while at the same time keeping to be ourselves by defending our European values. Thank you very much.
This is a little informal, but we agreed with Connie in the interest of time, we would take comments and questions from the floor for the remaining, few minutes, if anyone would like to offer a comment or a question. Please. And if you could just identify yourself when you speak.
There's a microphone coming.
Microphone kommt.
It's open. Thank you. Thank you, Adam, for your excellent presentation. And I see that you raise some foundation for a new kind of geography economy, which is different from the traditional one. I have three small questions for you. The first one, it's related to the swap, and this is a real issue, I think, in the medium term for the ECB if this risk materializes. What is the interest of the US to do so? Is it to create a crisis to stop swaps with the ECB? And the second question is related to the first one. Can the ECB deal with this issue via signing a medium-term contract, including a prime, and not relying only on a memorandum of understanding? And the third question, which is important also, is the international role of the euro. And you suggest the increase of safe, may say, bonds on international markets. How do you reconcile the excess of indebtedness of majority of European countries with this increasing of safe securities?
Thank you. So first off, on the swap lines, this is obviously not in the U.S. self-interest and any sort of enlightened self-interest, picking up on the public-private aspect that Thorsten was mentioning. And there's no circumstance at all under which the Fed would deny something directly to the ECB. The issue is more, does, in a moment of issue for a nationally based financial institution or an indebted particular country, does the US government, Treasury ultimately can assert control over the swap lines, say, we want to extract the following concession from you, or say, we have a geopolitical reason to slow this down. So it's very similar to things we're seeing in other contexts. It's a risk. Is it definite? No, and as I said, Chair Powell and Secretary Bessent had stated very clearly that for the time being, at least, the Fed controls the swap lines. And if the Fed controls the swap lines, they will not engage in this. But I think it would be unwise for the ESRB and for others not to take this risk into account. Sorry, I remember your third. Your second question was on the structure of it. Look, in the end, this is liquidity provision. This is about confidence. This isn't, you can make all kinds of fancy financial engineering or pre-position assets or try to make contracts. What matters is, in the Draghi-esque sense, whatever it takes. You say in the moment, we will provide enough liquidity. And in a sense, that's inherently less credible if it's not the Fed, because you can't print dollars. But with the trillions of dollars in reserves everybody has, it's not a practical constraint. So sorry, then the third question was the international role of the euro, sorry, and yes, excess of indebtedness. This is a debate, obviously, that goes back decades to the start of discussions about the euro, and it bedevils fiscal discussions everywhere. The idea that there's a reality that fiscal dominance is bad, and then there is an incredible leap, which has very little empirical support, that monetary tightening and fiscal rules can deter fiscal problems. And I repeat, this is an assertion that has repeatedly failed the empirical test. The very stylized fact you point to shows that the attempts to prevent moral hazard in the issuance of debt have not worked. Moreover, as numerous people have argued, numerous Europeans, the idea of whether it's Eurobonds or something else, I'm not going to carry water specifically for Blanchard and Obide, they can do that themselves. But whatever it is, joint funding of debt creates, not just financial engineering, is a meaningfully different asset class. And it is meaningfully safer. And then you can debate, and it is a technocratic in part discussion, what's the best way of doing that without opening the floodgates. But the repeated Northern European insistence that somehow we're getting into fiscal trouble because we're too lax has not been borne out. Other questions or comments? Anyone? We can't have bored you too much into submission. Or maybe we have.
Yes, yes.
Please. And you can talk to Thorsten instead of me, that's fine.
No, unfortunately, it's for you. Alessio De Vincenzo, Banca d'Italia. You were mentioning actually this idea of the ECB, the Eurosystem, the European financial supervision system to step up their role in providing insurance to governments. You were making an example related to the possible outflows of deposits in case of the issuance of the digital euro. Can you just elaborate a bit more what you have in mind and what kind of implication this might have for the mandate? Thanks.
You're welcome. I can only elaborate a little bit more because I've only begun thinking about it, and there are others who are probably well ahead of me. But I think it parallels various discussions of migration and trade relationships that Europe is having with the Med and with other economies, including some former colonies that have deep economic ties, historical ties to European economies. That you can be, this falls into the realm of what I was talking about. Europe has a lot of room to decide how proactive, how positive it undertakes the reality. The reality is, if the US is yielding the field in terms of having a central bank digital currency, and most people understand that Chinese central bank digital currency is not likely to come without its risks and conditions. To whatever degree there are Brunnermeyer, James Landau type outflows from other countries into the digital currency, I think they're going to be much faster and heavier to Europe, to the euro area, than people are currently foreseeing. And so the question is, just as one is dealing with trade diversion from China and the US, and one is dealing with migration flows, can one create a form of constructive coordination that doesn't reverse this, but does provide some amount of support, sharing of information, best practices, and so that it is not simply a laissez-faire, well, Europe's great, thanks for coming. Which would not be Europe's instinct anyway, but I flag this without pretense that I've got a great answer, but just that I think this is a meaningful thing to think about that presents both geopolitical and economic risks, particularly in the near neighborhood. And there should be a way to fix it, and I hope by raising it, smart people in this room or online will think of a way to fix it. Sorry, I'm not trying to duck it, I'm just being honest. Anyone else? Okay, then in which case, oh, there, please.
Thank you. Vasu Yanil from Base Business School and member of the Advisory Scientific Committee of the ESRB. My question is again to Adam. You mentioned Europe should not play their game and sort of hold the fort. In the long run, will benefit from maintaining a safe asset and a rule of law. Now, of course, you also point out to the dangers of someone holding the gun at you and you have to give in. So there is a tension here to be able to pass through the long term by side-passing the immediate dangers that will force you to open the gates. What will you say are the key things Europe can do at this stage?
Thank you very much. So if it hasn't been clear already, the following remarks will make it clear why I have not been appointed to high office in the US and am extremely, even on merit issues, but extremely unlikely in the current constellation. Look, if we truly go to a Hobbesian world of military action, where there's not that much you can do about it. Put very bluntly, the fastest way for Europe to reduce its risks on that, whether through French action or unified treaties with Britain or what, is to create a much stronger, credible second strike nuclear capability. I mean, that is the reason the US went for it and other countries went for it in the early post-World War II, because it's the cheapest way to assure security, it's the quickest way to assure security. Of course, the trick is what risks you incur in balance of terror and how do you make it credible. So it's not like that. But if one, and I'm not saying you should, but I'm not saying you shouldn't, if one is taking seriously the idea of overt military threats on Europe, all the other stuff is secondary, just do that fast.
It's a defense union.
Yeah, well, defense union isn't going to mean crap if you don't have enough military spending and enough forces, whereas you can have a second strike nuclear capability with submarines and bombers very quickly. So anyway, that's outside my field, but that's as close to central bank independence as a truism in security studies. So I feel comfortable having studied some of that. But just a little bit more directly relevant to your work with the ESRB and so on. Look, part of the main point of what I've been writing about and warning about and trying to activate for the last few years is that one of the things the Trump administration and their claque are getting wrong is that short of that kind of security world, others have agency. And it's not just governments. Investors have agency, multinational corporations have agency, even savers, small savers and consumers have agency. And so even if they're metaphorically pointing the gun at you in a given negotiation or a given issue, that doesn't mean the US wins and it doesn't mean you can't do anything. it may mean you need to strategically concede. And this is why I was out there publicly, including in the FZ, saying Europe was right not to escalate or retaliate on the trade round, because ultimately that's not going to get you anything in this situation. What you want to do is build up people avoiding the US or going to other sources or getting in resources from around the world that no longer go to the US and going into markets where the US no longer goes. And so short of the worst security scenario, I don't view it as a tension, I view it as a diplomatic management problem. How do you concede gracefully when you have to on certain short-term things without either annoying your domestic constituencies who feel you're showing too much cowardice or not standing up versus further encouraging or enraging the US, oh, they're soft, or oh, they're insulting us, we can go for more. But ultimately, frankly, the advantages lie with you now as they used to lie with the US. That doesn't mean the US won't be able to gain certain things in certain specific sectors, certain specific relationships where they exert force. But in the broad, particularly in the investment front, and the flows of capital, talent, technology, that is ultimately the bigger things. That is going to go to Europe if you maintain your situation. And so again, it's not easy. It's not your stuff to manage. There's issues of how carefully you encourage diversification away from the US, how explicitly, what do you do that doesn't, I mean, so it's not trivial. But fundamentally, I view the gun to the head negotiations as very secondary to the advantages that Europe has, and for that matter, ASEAN potentially has, or Japan potentially has, to a lesser degree. Thank you. I think we're out of time. Thank you all very much for your time and attention, and thanks to Thorsten.
Thank you.